Welcome to the Deep Dive. Today we're tackling a really fascinating case study in banking strategy, the transformation of IDFC First Bank Limited.
That's right. It follows the merger of IDFC Bank and Capital First, which happened back near the end of 2018.
And it's quite the story. We're going to look at how they fundamentally changed their entire approach in just about 7 years.
Exactly. We'll be using their Q2 FY26 results and the investor presentation data up to September 2025. Our goal here is really to pinpoint the specific financial moves that let them stabilize things so dramatically.
Stabilize and really invert their whole risk profile. That's the core idea, isn't it?
It really is. Think about it. They started out primarily as a wholesale lender, big ticket infrastructure stuff.
Right. High concentration risk there.
Definitely. And they flipped that script completely. Now they're heavily focused on retail, rural, MSME loans, granular stuff.
It's a huge shift, like you said, an inversion
Yeah.
from sort of institutional risk to mass market lending.
Yeah, swapping the battleship for, well, a whole fleet of speedboats, maybe. That foundation, how they rebuilt it, that's so interesting for anyone watching banking strategy today.
Okay, so let's set the stage. December 2018, the merger happens. What were the two pieces coming together?
Well, you had IDFC Bank. They had assets around 75,000 crore rupees back then, September 2018 figures.
And heavily skewed, right?
Oh, yeah.
Yeah.
86% of their loans were wholesale. Infrastructure was a big part. They had the banking license, which was valuable, but they were really missing a strong deposit base,
Yeah.
especially retail deposits.
They needed funding, stable funding.
Exactly. And then you had Capital First and NBFC, a non-banking financial company.
Different beast entirely.
Totally. Their focus was sharp. MSME and retail loans using technology for quick lending decisions. They'd grown their assets under management pretty impressively to over 32,000 crore.
So they had the lending engine, the tech, the focus.
Right. But they didn't have that cheap, stable funding source. They needed what a bank license provides. Access to OSIS, basically.
Current account, savings account.
Yeah.
The holy grail of cheap bank funding.
Precisely. So you see the synergy. One needed assets and expertise in retail. The other needed stable liabilities and a license.
Makes sense. But putting them together, you mentioned vulnerability. Where was the immediate weakness on day one?
It was all about the funding mix. Liabilities. Legacy IDFC Bank had a CASA ratio of just 13%. That's not great.
No.
And Capital First, being an NBFC, had zero CASA. So when they merged in December 2018, the combined bank started with a CASA ratio of only 8.7%.
Wow. Okay, 8.7%. That's really low. That tells you they're relying heavily on expensive money, right?
Yeah.
Wholesale borrowings, bulk deposits.
Absolutely. High cost of funds was baked in, very sensitive to market fluctuations. It basically screamed risk reduction needed urgently.
Which leads us straight into the big portfolio shift then.
Yes, the transformation on the asset side.
Okay, let's unpack this, because this is where the philosophy seems to have really changed. The Capital First DNA taking over, maybe?
You could say that. Look at the numbers. Pre-merger, September 2018, 86% wholesale loans.
We established that. Huge concentration.
Now, fast forward 7 years to September 2025. They've aggressively cut that back. The wholesale book is down to just 20% of their total loans.
20%.
Yeah.
From 86, that's a massive deleveraging from that segment.
It is. And it wasn't just about shrinking it, though. It was about growing the other side even faster.
Dilution through growth.
Exactly. The focus shifted dramatically to retail, rural, and MSME lending. That segment went from just 14% of the book pre-merger
Right.
to a dominant 80% by September 2025. And the total loan book grew significantly too, reaching about 2,066,579 crore.
So they didn't just swap assets, they grew massively into this new focus area.
Correct. And within that 80%, there's significant diversification. It's not just one type of retail loan. The investor presentation shows over 25 business lines.
Okay, like what? Give us a flavor.
Well, mortgages make up about 29%, vehicle loans are around 11%, MSME lending is 9%, and so on. Lots of different streams.
That granularity is key, isn't it? Reduces the risk compared to a few massive loans.
Absolutely. It spreads the risk widely. And you see the impact in the concentration metrics. Exposure to their top 5 industries. It dropped from 41% back in March 2019 down to just 19% by September 2025.
Okay, that's a tangible reduction in sectoral risk.
Right.
Much safer profile.
Definitely.
All right, so they shifted the assets. But here's where it gets really interesting. How did they pay for all this new retail lending? The liability side.
Yes, this is arguably the cornerstone of the whole transformation, building the deposit franchise. This was the critical enabler.
How critical.
Think about the numbers. Customer deposits went from about 38,455 crore right after the merger
Okay.
to 2,069,094 crore by September 2025.
Whoa, hold on. Say that again? From 38,000 to 269,000 core.
Yep, that's a sustained growth rate, a CAGR of 33% per year for 7 years straight.
33% CAGR on deposits. That's incredibly aggressive growth. How'd they manage that?
Well, initially, they likely had to offer attractive rates on savings accounts to pull customers in, build the brand, build the base. But the strategic goal was always CESA.
Right, back to the cheap funding, that 8.7% starting point.
Exactly. And the surge was phenomenal. That CESA ratio climbed from 8.7% in December 2018 all the way up to 50.1% by September 2025.
50% say so. That's more than a five-fold increase, almost 5.8x.
It fundamentally changes the bank's funding structure. And within those deposits, the retail component became dominant. Retail deposits jumped from 27% of the total at merger time to 79% by September 2025.
Sticky money, less likely to fly out the door than wholesale funds.
Precisely. It provides stability, predictability.
So the bottom line impact of getting all this cheaper, stickier funding, let's talk cost of funds, COF.
That's where you see the direct payoff. The cost of funds dropped from 7.8% around the merger.
Which was high because of that low CSA and reliance on borrowings.
Correct. Down to 6.23% in Q2 FY26.
Okay, 7.8 down to 6.23. That's a reduction of 157 basis points. That's huge in banking.
It's massive. It gives them so much more room to maneuver on lending rates, compete effectively, and still maintain healthy margins. It's the structural fix they needed.
And it allowed them to ditch the expensive wholesale borrowings too, right?
Absolutely. Borrowings as a share of their total funding deposits plus borrowings plummeted. It was a very high 48% back in December 2018.
Dangerously high.
Yeah. By September 2025, it was below 8%. They essentially replaced expensive market debt with relatively inexpensive, stable retail deposits.
That shift from 48% borrowings to under 8%, that's probably the clearest indicator of reduced systemic risk right there.
I'd agree. It points to a much healthier, self-sufficient funding model, which leads us to some other key structural metrics.
Like the credit-deposit ratio.
Exactly. The CD ratio. It measures loans relative to deposits. Remember, IDFC Bank started out lending far more than its deposit base.
What was the number again?
At the merger, it was 137%. They were heavily reliant on those borrowings we just talked about to fund the gap.
Okay, 137. And now?
By September 2025, it improved dramatically to 94.2%.
Sub 100, meaning their loans are now comfortably covered by their deposit base.
Precisely. They're funding lending primarily through deposits now, a fundamental shift.
Now, the big question with rapid retail growth is always asset quality. Did NPAs spike as they ramped up all this new lending so quickly?
That's always the concern, isn't it? But the data suggests they've managed it well, likely leveraging that capital-first underwriting skill. As of September 2025, gross NPAs stood at 1.86%.
Okay, under 2%. And net NPAs.
Even better, just 0.52%. Very tight.
That's impressive given the pace of growth. How do they explain that resilience?
Well, the presentation mentions something interesting. They talk about their retail, rural, and MSME book being tested through 6 stress tests over the last 15 years.
6 stress tests. What does that imply? Different economic shocks, presumably?
One assumes so. It suggests their underwriting models, likely focused heavily on cash flow analysis rather than just collateral, have proven robust through various cycles, that NBFC heritage maybe. Quick tech-based assessments.
Makes sense. Scaling that kind of detailed assessment is easier with good tech. Okay, what about efficiency? All this growth, the tech integration, is it showing up in profitability?
Yes, definitely. We're seeing operating leverage kick in. Look at core pre-provisioning operating profit, core PPOP, as a percentage of average assets. It went from a tiny 0.51% around the merger up to 2.21% in FY25. That's a significant improvement in core profitability before loan loss provisions.
And the operating leverage part, costs versus income growth.
Clear evidence in the first half of FY26 figures. Total business loans and deposits grew about 21.6% year on year.
Strong growth.
But operating expenses grew much slower, only 11.8%.
So revenue and business volume are growing nearly twice as fast as costs. That's the leverage you want to see.
Exactly. The platform is scaling efficiently. They can handle more business without a proportional increase in overheads.
Any specific examples of that efficiency?
Well, they highlight their credit card business. Launched relatively recently and achieved operational break-even in just 4 years. That points to a pretty efficient platform rollout.
Okay, so pulling it all together for you, our listener, what's the main takeaway here?
I think it's about the successful fusion of two different skill sets. You had the NBFC, Capital First, bringing deep expertise in granular lending, risk management for retail MSME, and the tech platform.
Right.
And you combine that with IDFC Bank's license and, crucially, its eventual ability to build that robust, low-cost deposit franchise, that CASA buildup, the COF reduction that was the financial engine that powered the whole asset transformation.
So the liability strategy enabled the asset strategy.
Absolutely. One couldn't have happened without the other. It was a managed integration, not just a merger on paper.
A truly significant turnaround story.
Which, raises an important question looking forward.
Okay, what's the provocative thought for today?
Well, the bank has ambitious targets. They're aiming for a high teens return on equity ROE and want to push their cost-to-income ratio down towards 65% by FY27. Very punchy goals.
Seems achievable given the trajectory.
Perhaps. But here's the thought. They achieved this amazing transformation fueled by that incredible 33% deposit CAGR and falling funding costs. How long can any bank sustain that kind of deposit growth rate before hitting market saturation? And as that growth inevitably slows down and competition likely intensifies, what pressure does that put back onto managing asset quality? Can they maintain those low NPAs when growth isn't quite as explosive? And maybe they have to reach a bit further for new customers. That's the next strategic chapter, I think.
Maintaining quality while navigating normalized growth. A different kind of challenge. The journey isn't over, but the stabilization phase certainly looks complete.
Agreed.
Fascinating stuff. Thanks for joining us for this deep dive into IDFC First Bank's remarkable strategic shift.